I wrote a book with the title The Triple Crisis of Western Capitalism in Democracy, Banking and Currency. I was working in my professional life with various companies, among them Boston Consulting Group. I was on the board of various companies. The last one was the board of Deutsche Bank. I did a venture capital fund, and finally I basically retreated for some time into the academic space, the result of which is this book. Currently, I would label myself as being an entrepreneur. I'm pursuing various projects in the Emirates and Germany. Until this afternoon, I thought that the script book, which is followed by all the by all the central banks, was written by Ben Bernanke. But I learned from Prince Michael that it was Lenin indeed, and which to me was the most fundamental insight today. No, I'm not joking. Huh? But anyway, in the words of Bernanke, he's basically phrasing the rationale for all this quantitative easing and other abbreviations. It's the belief that if you pump in money into an economic system, that prosperity will grow. That the theory is completely wrong and based on false assumptions is a different thing. Anyway, everybody is believing it, in particular all the Western central banks. So all the main tools were already mentioned. We have various rounds of quantitative easing, we have zero interest, we have negative interest rate policy. What will for sure come is helicopter money, and also we might see a ban of cash. And what is the toolkit of the central banks targeting at? It already was described by Mr. Kerber. They are basically buying assets from the private banking sector, and by that providing liquidity to the banking sector, and by that hoping that this newly created liquidity will find its way into productive investment in the real economy. Next rationale is that they want to create a kind of wealth effect, which was expressly stated by Bernanke. So what for the United States to recognize wealth is just having a view on the stock price indices. So as to that, they were certainly successful. They also want to create controlled inflation, already mentioned. I will explain why. The rationale of SIRP and NIRP is basically to bring down the debt service obligations of the sovereigns. Now let's check whether data support those statements, or whether the following data basically prove the assumption of the academic establishment. As already indicated, all the large central banks of the so-called advanced and over-indebted economies pursuing the same program. They are buying assets from the private sector, and you can see here the most important is ECB, Bank of Japan, Fed, and so on. They are all doing the same, and Bank of Japan being the clear leader of the pack. Richard Fisher, former president of the Dallas Fed, publicly admitted that the central banks created this kind of stock bubble or wealth effect. He stated in a January 16 interview, and if you compare the asset build-up of the central banks and the S&P 500, you can see a correlation. Same holds true for Japan. Since the GFC of 2008, only the top percent basically experienced this kind of wealth effect. The bottom 99 lost wealth, and hence the wealth effect didn't work for the middle class in all of the so-called advanced economies. This chart here is taken from the January 2016 World Economic Forum, where they were also discussing the increase of wealth inequality in all leading societies. And again, here you see a correlation between central bank policy and the build-up of equity prices. What indeed happened is that the median household income fell in the United States dramatically. Currently we are back at the mid-90s levels, so there's a lack of purchase power. So even if you pump more money into the economy, consumers, which in the case of the United States represent 70% of the GDP, simply cannot buy. And the monetary easing, again, it was already said by one of the others, we had indeed serious inflation, which is labeled asset price inflation, which we have in real estate, which we have in stock markets. The trick is why nobody talks about it is it's not caught in the CPI measurements. The CPI measurements of the Fed and of the ECB are a pure joke. The guy who designed the CPI measurement for the Federal Reserve basically doesn't eat, doesn't go to college, and doesn't drive. It's very simple. So what they are measuring is not the real life. But they were very successful with this kind of recovery propaganda, which is, excuse my French, bullshit. It never took place. What happened is that the whole employment stuff basically shifted from breadwinner jobs to part-time and low-wage earners. That's the so-called American recovery, which currently begins to go down the tube. And what also happened is the QE-driven injection of permanent liquidity into the banking sector did not flow into productive investment, as you can see in the United States. Instead, it enabled massaging of accounting, and in fact, the real investment fell from 3.7 in 2007, just 1 year prior to the crisis, to 2% in 14. And here you see what the cash was used for, primarily for share buybacks programs, enriching the management of the companies. And what also should be said, that all corporate earnings within this S&P 500 are heading south for the future. So there has to be a correction to take place in the stock market. We already said that SIRP and NIRP distorts completely market-based price discovery. Again, here I also have the examples of the, of some government bonds. In each case it's going down. Italy, Spain was shown by you, so it's a pure market manipulation. I still wonder why people think we are living in a capitalist system. We are not. We are living in a complete socialistic central planning system. Yes. It has nothing to do with capitalism at all. Coming again back to NIRP, the introduction of NIRP is extremely hefty. It's now almost, I believe, 20% of the total debt, sovereign debt outstanding globally is now basically coming along with sovereign interest rate, with negative interest rates. So the big question is, how can pension funds earn the money? And here we are. NIRP will hurt retirees in advanced economies worst. There are some statistics which is called the liability gap. It went from 200, basically 300 billion are missing, and moreover, the number of retirees is growing. So, and here an example of the United States. At the end of 2013, the median income plan for 1K is a kind of defined contribution plan. Held by US households near retirement had a balance of $104,000 according to the National Institute of Retirement Security. Following the typical actuarial recommendation of withdrawing no more than 4% a year, this would provide an annual income for one retiree of $4,000 a year. So we have any reason to look very optimistically into the future. And again, why are SIRP and NIRP introduced? It's a pure power play. It's a thing of conservation of power. It has nothing to do with financial theory. It has nothing to do with central banks. Central banks are simply the helpers of governments. Here's an example. In case the interest the United States had to pay would go back to the 80s, the United States would be immediately bankrupt. Because the debt service, the interest service, I'm talking only about interest service, would go from roughly $500 billion to $2 trillion, which basically is a complete annual budget almost of the United States. If that should happen, they can sell their aircraft carriers on eBay. But that's a true reason of SIRP and NIRP. It's a political power game, just to keep the system running. And it was also already mentioned by a colleague, the announcement of the CSPP. I like those abbreviations, but they are not as creative as the FED. The CSPP, they started buying the corporate bonds. It's a monetary crime for various reasons. What they are basically enabling is speculators. They published the bonds which are eligible for purchase, and you have a list what bonds are left. So if you are a trader, you buy what was not bought in the first run and you will make tons of money. So in financial markets, such behavior is called front running, and you usually go to jail. And here's a list of what they bought. Basically, they are buying almost everything. And there was a very interesting on Zero Hedge, an article on what they bought. They did a very interesting analysis. They bought everything, junk in particular. No, it's not a joke. Yes. Again, CSSP is a textbook example of massive market manipulation through central planners. Price finding mechanisms are completely eliminated. There's a nice thing. I put it in because just in the current G20 level, I think the most important outcome was that the leaders decided to watch and monitor the global steel overcapacity, which in turn was created by easy money. And now they are fighting the overcapacity of steel, which basically will force to the closure of various steel plants and will increase unemployment. They at least decided to monitor it. I think it's a great thing. Again, what happened, there's a clear causation. When ECB began its CSPP, within 6 months, basically interest rates corporations had to pay went down dramatically. I think this policy clearly has impact. Whether it's a good one is a different question. The next question, because we are running against the timeline, it was also mentioned by another speaker. By January next year, there will be no government bonds left eligible for ECB purchases. So if the ECB cannot buy more bonds, if nothing happens and if they don't change the rule fundamentally and radically, you can see the bond market, you can watch the bond market imploding, because if the main buyer basically goes out of business, you can see it will have serious effects. So that's the reason why I'm expecting that latest by January 2017, ECB will basically follow and adopt the example of Bank of Japan. They will buy everything, shares in particular, massively, and they will buy your car, your house, whatever, until the end is reached. But we can expect the ECB to buy shares by the latest by the beginning of next year. Now coming back to the role of inflation, I think it's very logical. Again, we are talking about power. We are not talking about central bank and economic reasoning. I did here in 3 scenarios. We have assume an inflation, a real interest rate of 2%. Assume you can get 2% on a saving account. Assume a tax rate of 40%. Your net interest income is 1.2%, and the one of the government is 0.8%. Now change the assumptions: inflation 2%, real in interest rate 2%. The outcome is 2.4% of net interest income for you, and of the government 1.6. So the government doubles its income. Now to do it a bit further, inflation rate 4%, real interest rate 2%, net interest income and saving grade 6%. But what changed is your net interest income goes down to minus 0.4, and the government income goes up to 2.4. So they are making again, it's a kind of money creation, or it's a kind of hidden taxation. This is and the reason why they are adopting is, first, they create a tax-like income, and secondly, if nominal GDP growth is above the normal interest rate, the debt to GDP ratio will become more favorable, and by this reduce the overall indebtedness. If you can grow GDP by inflation, you achieved a great thing. You are reducing in relative terms your debt, and your debt to GDP ratios are going to look nice, and you can take on more money on the global markets. Did the ECB meet its target so far? Clearly no. The officially measured inflation, one second. The officially measured inflation is clearly below target, and the long-term growth expectations for the euro area and the US are meager, in particular for Europe, and there's a but. It might come even worse, because there was published in January 16 this year, IMF study basically projecting or predicting shrinking GDPs and shrinking real investment, which is not good for growth and which is not good for employment. Because the problem is that the so-called macro-prudential policy cannot substitute the need for new reforms, and I put in the footnotes a nice example. I think France is in particular dangerous, and there was a very good analysis by the IMF in May or January this year, basically showing that the French political system and economic system has no chance of survival due to political forces. There's another thing what mainstream economists do not understand, that's the role of debt. I think there are two other economic schools who clearly understood it. The one is called the post-Keynesians. The most prominent representatives of them are Stephen Keen and Michael Hudson. Both of them wrote excellent books, and of course the Austrians. But in the case of the post-Keynesians, they are saying there is a productive sector in the economy which produces goods and services not depending on rising asset prices. And there's a fire sector which income depends on debt and rising asset prices. So fire sector is finance, insurance, real estate. So in 80 to 2008, the fire sector crowded out the productive sector by providing greater returns on capital invested in asset price inflation and interest on debt than investment in productive enterprise. That is what happened. In the GFC, the global financial crisis, the fire sector collapsed. You all remember the large bailouts which were required. This collapse spilled over into the productive sector by reducing consumer and business access to all forms of credit. A collapsing fire economy, and that is what happened, is accompanied by debt deflation, falling demand, debt defaults, business failures, and rising unemployment. If bad debt is not written off, deflation continues. This complex was already identified and clearly described in the 30s by Irving Fisher, the only way to basically overcome such a collapse is you have to write off debts. If you don't write off the debt, it's going to continue. So, last one, what central planners didn't achieve and what they did achieve. Central planners did not achieve, they did not meet their own inflation targets. They did not achieve higher employment. This remind in particular the IMF prediction we saw just 2 charts ago. They did not achieve sound economic growth, nor higher, what they call, the Keynesians call, higher aggregate demand. And they did not achieve the reduction of debt, which I think is clear. You cannot overcome too much debt by even more debt. Doesn't make any sense. And anyway, but what did they have some achievements. They achieved a massive asset price inflation, particularly in stock, bond, and real estate. All of those three are now in high risk status. They achieved stagnation and reduction of median household income, and they basically performed a massacre among savers and retirees. Remind the charter is what is called the liability gap. It's a crime. And they achieved a massive build-up of public and private debt. So let me conclude, not in my words. I'm giving here a quote from Ron Paul, an Austrian and former member of the United States Senate. The financial crisis has fully exposed the intellectual bankruptcy of the world's central bankers. Why? Central bankers neglect the fact that interest rates are prices. Manipulating those prices through credit expansion or contraction has real and deleterious effects on the economy.